Hovnanian Enterprises missed their Q3 2026 consensus today, snapping a remarkable 23-quarter streak of hitting or beating pre-tax income guidance.
Yeah, 23 quarters is a massive run to break.
Right. I mean, looking at the numbers, revenue came in at $705.75 million, so they missed the $723.5 million estimate. EPS was a 70-cent loss, missing the projected 56-cent loss.
Ouch.
Yeah, but Q4 guidance actually remains strong, projecting 800 to 900 million in revenue. Wall Street, though, they did not care. The stock got instantly punished, dropping over 12% to around $112 right after the release.
Well, the market really zeroed in on that adjusted pre-tax loss of $2 million, and the
And
primary culprit there was lower than expected income from their unconsolidated joint ventures.
okay, unconsolidated joint ventures.
Yeah, which is just driven by delays in newer communities. So basically timing issues.
But wait, I mean, if it's just a check delayed in the mail type of thing, isn't a 12% drop a massive overreaction? Like, is this a structural failure in how they're building or just, a temporary timing hiccup?
Oh, it definitely looks like just a timing issue, because when you looked past that headline miss, the underlying operational strength is absolutely there. Gross margins actually improved sequentially for the second quarter in a row, hitting 14.6%.
Wow, okay.
Yeah, and their SG&A expenses, the actual corporate overhead, fell to an impressive 12.3% of revenue.
Right, so they're controlling costs tightly. And I guess this ties directly into management's whole strategy shift, right? Moving away from those highly competitive entry-level homes and targeting move-up buyers and the active adult market. It's kind
Right.
of like upgrading a restaurant from fast food to fast casual. Like, yeah, it takes time to transition, but the profit margins are just so much better once you do.
That is a perfect analogy. And to pull that off, Hovnanian is using what they call a land-light strategy. Right now, a record 87% of their lots are optioned rather than owned.
Oh, so instead of buying all the dirt up front, they just pay a fee to call dibs, which preserves their liquidity.
Precisely. But, you can't ignore the macroeconomic risks management flag today. Mortgage rates remain really high,
Always a huge pain point.
always. Plus, general geopolitical uncertainty is keeping buyers hesitant. What's interesting, though, is they noted website traffic is actually surging. People are browsing, but they're just terrified to sign the dotted line.
Right, they're sitting on the fence waiting for rates to drop.
Exactly. And you layer on a slight creep in construction and lumber costs, and the market's jumpiness starts to make a lot of sense.
It makes sense for today, maybe, but 82% of their current lot portfolio was underwritten after these high rates and construction costs became the norm. So their models already bake in today's brutal conditions.
Which is exactly why their strong Q4 guidance points to a really sharp profitability rebound. But I want to leave you with a different angle to think about here.
Let's hear it.
Wall Street is obsessing over a single quarter's joint venture delay. But with 82% of their portfolio underwritten post-incentive hikes and strong Q4 projections, are investors just completely missing the forest for the trees?
That is definitely something to chew on. Make sure you follow the show for your daily earnings coverage so you're always up to speed.